Let's spend a little time together learning about universal life insurance. Universal life insurance is a type of permanent insurance policy, and I like to teach off it because it lets me dig into all the moving parts. There's other types of permanent policies with fewer moving parts, but universal life's a good starting point. We can see all the moving parts and we can decide how it works, and then we can make some decisions about, is this for me, is this not for me? First thing about permanent insurance is that it's going to have a cash value component. And what that means is the policy owner is going to have access to an account, and that account is held at the insurance company, and the policy owner can do any number of things with that account. They can take withdrawals out of the account. They can borrow against that account. They can use that account to pay premiums. They can use that account to pay paid up insurance addendums. They can do all sorts of things with that cash value over time. So, is this for me? Well, permanent insurance inherently costs more. It costs more for two main reasons. The first reason is that you're making a longer commitment with the insurance company than with a term policy. With a term policy, they are committing to you for the length of the term. Maybe they'll commit to you after, but it could require more underwriting and more costs. With a permanent policy, you are committing for the life of the insured. So we're saying, I'm going to buy this at 50. I very well may hold it until I pass away one day. So there's a difference between an insurance company committing to someone for 5, 10, or 20 years and committing to someone for life. So that's going to be a bigger investment and risk on their end. Number two, you've got these cash value components. So they do require some funding, right? They're just, you got to put some money in, put some money in, put some money in. So between longer promises and cash value components, universal life is going to be more expensive than term. All right, so just right off the bat. So will other permanent products as well, especially at first. So one more thing I want to hit is let's think about what happens to the premium of a permanent insurance policy, in this case, universal life. So we're going to take universal life and we're going to take a premium. What are we going to do with it? Well, some of that premium goes into the statutory reserves, which again is the present value of future benefits paid out minus the present value of future premium collected. And the state requires the insurance company to have that component. It's going to be a little more coming out than a term product, especially up front, because we're going to fund the statutory reserves for a longer period of time, raising the present value future benefit, right? Number two, insurance charges. Well, the insurance charges aren't locked in universal life, but we're looking at around 25% to 40% of first year premium. Goes to this idea that, okay, well, maybe, so-and-so passes away, whatever it is, we'll put those aside. That's the cost of insurance, mortality margins. We have quite a bit going to expense load. That would be everything from paying a commission to paying the broker to having administrative costs, underwriting. We can build in profit there as well. And then what's left is cash value going in the insurance owner's account. Right? So that's how we're going to break it down. If you price out in 2025, someone in preferred, good health, non-smoker, living parents, you've got $500,000 death benefit in the United States. I priced that out around $1,400 a year. So that's a $1,400 premium. The way it might break down, and of course this varies by insurance carrier, I had about $280, 20% going in that statutory reserve. That's going to be the account the state requires the company to have. Insurance charges, I modeled with the same as the term video that we shot. So we got about $100 a year. This is a 25-year-old healthy person. It's going to be pretty low. Expense load is going to be pretty high the first year. Right? We have a lot of costs. We have underwriting costs. We're probably going to pay an agent a commission kind of cost. So expense load starts high, and then what's left goes to that cash value. In this case, it was a little over 20%, goes in the cash value of around $330. So that models this idea of like your first year of insurance. Now, before we dig any deeper, we're going to kind of stop at the first year, but understand it changes. The expense loads go down over time. Insurance charges I'll talk about in the next video, but we can do some things to keep them low. And then the reserve is going to go up over time too, to make sure that insurance company has enough to pay death benefits if somebody passes early. So those are the costs, and that's how UL works on a surface level. We're going to dig a little deeper here in just a minute.